I recently stumbled upon an intriguing video clip featuring billionaire investor Bill Ackman, where he shares his thoughts on the U.S. economy, the reasons behind the longevity of inflation, and most importantly, how to safeguard your wealth from the detrimental effects of high inflation. Ackman is of the opinion that long-term rates, such as the 30-year rate, will continue to rise. There are several factors contributing to this potential increase. Firstly, a government shutdown seems likely, which would lead to a pause in the release of crucial data that affects interest rate adjustments. Additionally, there is a significant disparity in the bond market, where the supply of bonds outweighs demand. Countries like China, Russia, and Saudi Arabia are selling their U.S. securities, while the domestic economy remains robust with an inflation rate of approximately 3.5% to 4%. Given these circumstances, Ackman believes that investing in a 30-year contract with the U.S. government at a fixed rate, currently standing at 4.7%, is not a wise decision. He forecasts long-term structural inflation to be above 3%. The financial crisis triggered an unprecedented period of low interest rates, resulting in widespread affordability. The Federal Reserve's objective was to prevent deflation and achieve 2% inflation. However, the pandemic, combined with trillions of dollars in fiscal stimulus and the psychological impact of post-lockdown freedom, intensified inflation. Furthermore, the government's substantial deficit spending and infrastructure plans have led to the sale of hundreds of billions of dollars worth of securities. As the Federal Reserve's balance sheet shows an imprudent distribution of debt, Ackman suggests that if the U.S. were a business, it would not have such a significant portion of its debt repricing within the next year. Ackman gives credit to former Treasury Secretary Steve Mnuchin for his management during his tenure. However, he believes that Mnuchin missed an opportunity to issue long-term bonds at incredibly low interest rates. Current investors like Ken Griffin and Rick Reeder of BlackRock are also concerned about the massive issuance of bonds and the potential lack of buyers. As a result, real rates could remain higher for a more extended period than anticipated. To elaborate further, Ackman highlights the 30-year Treasury instrument, stating that it shouldn't be used as a short-term economic speculation tool. Instead, it represents a fixed-price contract with the U.S. government for 30 years and reflects structural forces. These structural forces, according to Ackman, have changed over the past couple of years. One significant change he points out is the surge in inflation, which has reached levels unseen in generations. In June 2022, the U.S. experienced a peak inflation rate of 9.1%, reminiscent of the early 1980s. Inflation hadn't been a significant concern for the U.S. economy for decades. Interestingly, just a few years ago, economists were actually worried about low inflation. Ackman goes on to discuss the actions taken by the U.S. government and the Federal Reserve in 2020 and 2021 to prevent an economic collapse. These measures included sending cash directly to households, boosting unemployment benefits, and pausing required payments on certain types of debt. Additionally, the Fed slashed interest rates to historically low levels, making it cheaper for individuals and businesses to borrow money for purchases. In the context of used cars, these actions resulted in an increased demand for them. People had more money in their bank accounts due to the cash injections, and the lower interest rates made it more affordable to purchase cars using loans. As a result, the demand line shifted to the right. However, during this time, automotive manufacturers faced supply chain issues that limited their ability to produce new cars. Consequently, people held on to their current vehicles for longer periods, leading to a decrease in the supply of used cars available for sale. This caused the supply line to shift to the left. The intersection of these two lines occurred at a much higher price point, leading to a significant increase in the prices of used vehicles. Ackman acknowledges that this explanation is a simplification of how inflation works, but it conveys the important message that inflation occurs when there is excessive demand for a particular product or service compared to its supply in the market. While some argue that this inflation is only temporary, Ackman disagrees. He believes that we are entering a new normal of consistently higher inflation. He points out several factors that contribute to this belief, including the structural changes in the world, the elimination of the peace dividend, the diminishing deflationary effects of outsourcing to China, the increasing bargaining power of workers and unions, the rising number of strikes resulting in substantial wage gains, the expensive nature of the green energy transition, and higher gas prices leading to inflationary expectations. Furthermore, Ackman highlights the potential consequences of high inflation, such as higher interest rates. To combat inflation, the Federal Reserve may need to raise interest rates at a faster pace, which could significantly impact stock prices. However, Ackman remains unfazed by this prospect, explaining that a negative view of the equity market is necessary when considering the outcome for bonds and yields. He believes that owning high-quality businesses with pricing power is key to maintaining a positive view of stocks. In a world of 3% inflation, many businesses can thrive. However, volatile inflation rates of 8% or higher can pose challenges for businesses. That being said, there are certain types of companies that can perform well even in the face of inflation. One example of these companies is Universal Music, which essentially acts as a royalty on music streaming. Every time a song is streamed, Universal receives a fraction of a penny. Similarly, Google acts as a royalty on advertising on the web and YouTube. Restaurant Brands operates as a royalty on people dining at Burger King and other related concepts. Hilton, on the other hand, functions as a royalty on people staying in hotels and engaging in various activities such as dining and attending events. The advantage of these businesses is that inflation can actually be beneficial to them, as long as their costs do not increase at the same rate as their revenues. This is because their business model allows them to maintain profitability even in inflationary environments. From a historical perspective, the value of a business can be determined by calculating the present value of the cash it generates over its lifetime, discounted at an appropriate interest rate. Our discount rate for evaluating businesses has typically been around 10% or 9%, taking into account the inherent uncertainties of investing in equities. In summary, while inflation can present challenges for businesses, companies with pricing power, such as CPKC and Chipotle, stand out from the average business. According to Warren Buffett, a company that can raise prices without losing customers to competitors is considered a solid business. On the other hand, if a company hesitates to raise its prices even by a small amount, it is likely a weak business. Having experienced both scenarios, I can attest to the importance of this distinction. Inflation can even benefit asset-light businesses like RBI. For instance, if a $1.10 order increases to $1.15 due to inflation, RBI's fee, let's say 10% of sales, also increases. Previously, RBI would have earned $1 from that purchase, but now it earns $1.50, representing a 50% increase. This is what Bill Ackman means when he describes stocks he seeks as royalties on an industry. While we can't predict the future, only time will reveal if Ackman's predictions about inflation and interest rates are accurate. It's worth noting that Ackman is a polarizing figure, but his success in investing, with an estimated worth of $3.6 billion, cannot be denied. So be sure to subscribe to the channel, as my aim is to enhance your investing abilities by studying the strategies of the world's greatest investors.